Good morning, everyone, and welcome to today's important webinar. My name is Tim Zunker. I'm the president with the Shakopee Chamber of Commerce, and I'm delighted today that you've joined us for this timely and essential discussion. As business leaders, we're constantly navigating new regulations and programs that impact our operations and our teams. Today's topic is particularly crucial because Minnesota's paid family and medical leave program is coming, and small businesses need to be prepared. I'm pleased to introduce our presenter, Jen Stratton, owner and CEO of Flagship Insurance Services. Jen brings extensive experience in helping businesses navigate complex insurance and benefit programs, making her the perfect guide to walk us through this important topic. In today's session, Jen will break down the differences between the state-run public option and private paid family medical leave alternatives, giving you the knowledge and tools you need to make the best decision for your business and your employees. This isn't just about compliance, it's about making strategic choices that will benefit both your bottom line and your workforce. So, Jen, the floor is yours. Thank you for sharing your expertise with our Shakopee Chamber community today.
Yeah, thank you, Tim. And thank all of you for joining us today. This is our last informational webinar in a series of webinars and seminars that we've given this year around Minnesota's new paid family and medical leave program that takes effect on January 1st of 2026. As Tim mentioned, this topic is so important because every employer in the state will be required to participate. The key decision for most employers is how do you comply, either through the state-run program or through a private insurance option. And so today's webinar, we've gone through a series of webinars already up to this point, but today I'm going to just give you a quick overview about Minnesota paid family and medical leave, and then I'm going to walk you through the private market option, why it might be beneficial for your organization, and how Flagship can support you in navigating the change to ensure that you are compliant while also managing costs and, importantly, the employee experience. So starting 2026, all employers, every employer must provide paid family and medical leave benefits to your employees. This is a new state-run program similar to unemployment insurance, but it's for family and medical leave needs. Under the program, employees may take paid time off to bond with a new child, whether it be for birth or adoption or foster placement, care for a seriously ill family member. And I do want to mention that the definition of family by the state of Minnesota is very broad. For employees to recover from their own serious health condition, to address any certain military or family needs, and also to seek safety from domestic violence situations. I mean, really, you can think about it this way. There are essentially two buckets of paid leave starting January 1st. We have one bucket for medical leave, which is very similar to like a short-term disability policy. And we have another bucket for family leave, which is similar to FMLA, the federal law for groups that have 50 or more employees. But this program is defined by the state of Minnesota, and it includes paid leave with job protection. So paid benefits can include up to 12 weeks of medical leave. So that medical leave bucket has up to 12 weeks that somebody could take based upon medical leave requirements or eligibility. And then that second bucket of family leave, an employee could take an additional 12 weeks of family leave. But there is a maximum amount of leave between the two buckets, a maximum amount of 20 weeks combined per year. So who's affected by this new program? Certainly employers are impacted. The new PFML law applies to every employer in Minnesota, from the smallest businesses with a single employee to large corporations with thousands of employees. And unlike some other employment laws, there is no size-based exemption. So, for example, FMLA is really only for employers that have 50 or more employees, and companies or employers with less than 50 employees, they don't have to comply with FMLA, just as an example. Under this law, there isn't any employer that has an exemption. Even if you have just one W-2 employee, you're required to comply. This includes registering, collecting contributions, providing employees with their notice of rights, and managing the program, whether it's under the state-run program or a private plan. If there are any of you out there that are self-employed, or maybe you're an independent contractor, you actually can opt in voluntarily to the program and pay the full contribution yourself. And some employers, some small employers, employers with fewer than 30 employees, actually will qualify for a reduced rate. That reduced rate, we'll get more into the rates later, but the reduced rate is 0.66 rather than the 0.88 rate that is the standard rate for January 1st from the state. So as far as employees are concerned, employees are impacted as well. And the program covers nearly all employees working in Minnesota, whether they're full-time, part-time, seasonal, or brand new hires. If they're on your W-2 payroll or your payroll and they are going to receive a W-2 at the end of the year, they're included in the program. And yes, that also includes owners of the company. If as an owner, you're getting a W-2, your W-2 is going to be included in the calculation and the payout and the benefit eligibility of this program. The only real limitation there is for eligibility as an employee is that the employee needs to earn at least 5.3% of the state average wage, annual wage, in order to qualify for PFML benefits. For context, that wage is roughly $3,700 annually, and that amount really can adjust every single year based upon the state average. Employees who work at least 50% of their time in Minnesota qualify, even if they work remotely or in multiple states. Alternatively, employees working mostly out of state may still qualify if they live in Minnesota at least half of the year and perform some Minnesota-based work. Unlike some programs, PFML does not require a minimum number of hours worked. So like if you have employee benefits and you require that the employee must work 30 hours per week to be eligible for your benefits, this is different. This does not require any minimum number of hours. The eligibility of the employee is solely based on meeting the earnings and the location thresholds. So from an employer standpoint, you will be reporting wages and paying contributions for almost all employees on payroll in Minnesota, regardless of their scheduled hours. So while every employer is automatically going to be enrolled in the state PFML program, there is an alternative. And that alternative is the fact that you can purchase a state-approved private plan instead of leaving and allowing the state to take over the program as default for your organization. To qualify in order for a private plan to qualify, it must provide benefits that are equal to or better than the state plan. And that really ensures that employees have the same protections no matter which route the employer chooses. But employers who choose to go to the private option, they are required to formally opt out of the state program through the state's approval process. And we'll talk about that in another moment as well. But as far as Flagship's role in helping you evaluate whether a private plan makes sense for your business, to gather competitive quotes and walk you through the state approval process. And we also provide ongoing support once the plan is in place. So that's our role in helping you navigate this new requirement. There are advantages to choosing a private plan. First, the state rate, a standard state rate is set at 0.88% of payroll for 2026, but that rate can increase annually with no cap. And it's going to increase based upon the actual claims that come in through the state and that the state pays out. And they're going to pool all the claims together and determine what rate they need to charge all of their employers in the state pool moving forward. While private carriers, they actually, and we have maybe over 50% of our employers that we provide employee benefits for and that we have a relationship with on the insurance side. About half of them have received a more competitive rate than what the state rate is. So the savings to the employer or an employer can gain savings by moving to a private carrier too. And how you get those is if the carrier considers your group's risk profile as favorable, they will offer you a lower rate than the state rate. And it means that you're going to benefit from your risk profile moving forward by keeping that rate low. If you're larger groups, some carriers right now are offering multiple year rate guarantees, and that helps provide predictability and helps employers budget long term as well. An important piece of this is most employers have maybe a short-term disability policy, maybe you have a long-term disability policy or a combination of both. Everybody has unique and custom PTO policies. You might be eligible for FMLA or maybe you're not, but private carriers can administer PFML, that requirement, as a plan alongside any of those other benefits to reduce your duplication, to improve efficiency, and to simplify the employee experience. Your claims can be coordinated too, preventing confusion between PFML, short-term disability, FMLA, and PTO. Otherwise, when you're working with the state and the state is running the PFML option, they have no insight into your unique needs as a company, and they ultimately don't care. They're going to be implementing and administering PFML only, and then it's up to you to figure out how PFML will coordinate with your short-term disability policy or long-term disability policy, FMLA, or other PTO benefits that you have in place for your employees. Another advantage of being with a private option is that the state-run program will have a centralized processing unit with limited employer input. Private plans allow employers to maintain some control over service standards because you'll have access to, through a portal, all the claims, and you'll understand when your employees are getting paid, when they're going to be coming back, and a lot of additional information and communication that is really on par with a private option. And employees are going to receive faster decisions on their claims. The carrier, a private carrier, is going to evaluate the legitimacy of the claim, and they're going to coordinate the support, reducing all of the HR burden on your end too, which is helpful for a lot of employers who just don't have the capacity to try to help work things or move things along with the state option when their employees are not receiving a good experience. A private carrier, typically they provide dedicated leave specialists as well. They have online portals, as I mentioned, mobile apps for your employees to file claims, proactive communication, and that really improves employee satisfaction and helps reduce turnover. We've seen that already in the other 12 states. We're the 13th state in the country to require or implement a PFML policy. So in other states that we are seeing a retention return on investment by purchasing coverage through a private carrier. There are also education and resources that are often more robust with a private carrier than on a state option. And then this is a really big, important piece because it hasn't been the case up to this point, even for those other states that are offering or that require a PFML program. But the one big, beautiful bill that was passed by the federal government a couple months ago, it now provides tax credits, federal tax credits for private PFML plan premiums. So there are tax credits that are available only if you purchase a private PFML insurance plan. So that's something to take into consideration as well, because that can help lower your overall cost of this program moving forward too. And then finally, as I mentioned too, it is a private option is a higher touch program. And to me, and even to my employees, it really signals an investment in my employee well-being. They're going to be paid faster. The claim is going to be evaluated. The burden for somebody to um, pick up the workload of another employee who's out for a long period of time, if their claim is not legitimate, um, and if the state rubber stamps it, that those sorts of things cause frustration and confusion within your organization, and you won't get that with a private carrier. It provides a much smoother, more supportive employee leave experience to the state-run program. One question we get frequently is whether or not a private option will work, or whether or not it actually will be more work than allowing the state to take over administration. But what I can tell you is that you have the same responsibilities under a public option that you have under a private option. Your first responsibility is with either option, it doesn't matter. Every employer is required to register for PFML with the state. So with deed, they've already opened that up. Any employer can register already, but you're going to be required to register whether you go with the public option or go with a private option. If you decide to go the private route, you'll use your state registration account to file for a plan approval and to renew your private plan annually, because the state requires that you opt out of the state program, and you do that through the state portal. Employers under both options are going to be required to withhold employee contributions if you plan to pass on any of the cost sharing to the employees. And you obviously must pay the employer share on a quarterly basis. With a private plan, contributions are paid to the carrier instead of the state, but the payment and the frequency and reporting is similar between the two options. So there's no additional work just because you would be submitting that to a private carrier instead of the state. Another thing to note is that employers, regardless of the option, you're going to be required to give your employees a written notice about PFML rights, their benefits, and how they file a claim before the 1st of December. Those notice requirements apply whether you have the state option or private carrier administers the plan. The only difference is with the state, there's a template that you can work with from the state to give out that notice to employees. And if you work with a private carrier, the private carrier is going to model out a notice for your employees for you. Employers are going to want to work with their payroll providers to track wages, contributions, and leave usage to ensure that the accurate reporting to the state or the private carrier is being performed up to the requirements or compliantly. Job protection. Eligible employees must be reinstated to the same or equivalent job after PFML leave. This is a legal requirement regardless of the plan type, state-run or private. Employers are going to be required to continue group health coverage during an employee's PFML leave, just like they would under FMLA rules. Employers also need to manage PFML alongside PTO, FMLA, disability, and company leave policies, regardless of the option. And as I mentioned before, a private carrier will be able to help an employer do that automatically. And then the big thing you have to know, employees cannot be penalized for using PFML benefits. So you want to make sure, especially with a private carrier, that there is somebody in your corner vetting and evaluating the claims for true eligibility. And that is the kind of work that a private carrier does do. So, how do Flagship, how do we support employers? Well, we start really by looking at your unique situation. Everybody has a unique situation, the size of your workforce, the cost impact, and how PFML will interact with your current benefits. And not every employer needs a private plan, but we'll help you decide if it's the right move. There are lots of things to consider and to look at and to evaluate in that process. And we can help you evaluate whether or not it's the right fit. We also put the state option and private market options side by side. So you have a really clear picture about the cost impact, the rate stability, and we'll talk more about, if you're interested in a private option, the service experience that your employees will receive from a private carrier over the state program. We also go out to carriers on your behalf. We gather those quotes, we bring back the proposals, and we make sure that the proposals that are being submitted exceed the state's required benefits, because just a simple basic requirement of any private plan. And if you choose a private plan, we're going to assist you in the filing and the approval process with the state to ensure that you stay compliant. That's a big part of this whole program, so that you don't have to really worry about the paperwork. And we also coordinate with private carriers to provide communication templates, those initial notices, any FAQs that you think might be helpful, and additional educational support to help your employees understand their benefits. And, of course, our role doesn't stop there. After the setup, we stay with you for the claims questions, issue resolution, and renewal time to ensure that you're continuing to get the best value out of the program. One other thing that I want to just mention, because I get this question a lot, is, well, how does Flagship get paid? Is there additional cost for having a private plan through Flagship? And the answer is no. Employers don't pay Flagship directly for our consulting or support. Just like with any group health insurance or other benefit that you might have, our compensation comes through the insurance carrier. It's built into the premiums that you're paying. So there is no additional no additional fee or compensation. So the last thing I just kind of want to leave you with is that we've really designed as an organization, once we knew that this program was coming down and going to be impacting all employers, we designed a simple path for our employers, and what we call the easy button, to help employers navigate the new PFML requirements without the extra stress. It starts with you sharing a few key details with our team through a short online data form. And if you want a copy of that online request, let us know and we'll get it over to you. It gives us the information that we're going to need to evaluate your options thoroughly. And then our team is going to gather private market quotes and schedule a consultation to walk through them with you side by side with the state comparison. And then once you decide which option is right for you, if you select a private option, we're going to guide you through the setup and the coordination of all the implementation details, ensuring that you have a smooth transition while remaining compliant. And our support continues after that, as I already discussed. But I just want to make sure that, our job, our role is really to make this easier on the employer. This is something that is frustrating a lot of employers, and a lot of employers don't know where to even start. So, regardless if you're going the state route or a private option, we'd be happy to at least help you get started and know where to start and start evaluating your options to see what's the best fit for you and your employer, or you and your company. So before I close and we can open it up for questions, I just want to leave you with the fact that the Minnesota PFML is coming January 1st, 2026. Every employer is going to be impacted, and the state program is the default, but the private option does give you more control over costs, claims, and certainly the employee experience. Our role is to guide you through those decisions and make sure you're compliant, informed, and supported. And we just want to make sure that people can get through this process as easy as possible. So thank you for your time today. Here to answer any questions you might have. And we can open it up now if we have time, Tim.
Great. Yes. Thank you, Jen. I'm going to look at the chat first, but then if somebody wants to add a question to the chat or just unmute. Either way works. First question is they just want a copy of the easy button. They have three companies they need quotes for. And I know you mentioned the jot form. Is there other ways to get a hold of Flagship? Should they contact Nick Kuchenbecker? What would you recommend?
Um, yeah, either one we can, they can, I can put my information, or can you put our emails in the chat box and,
Yes. Yep, I'll do that right now. And if somebody else has a question, please feel free to unmute while I put those emails in there.
yeah, when you reach out to us, we're probably going to want to just have a quick conversation. We need to know what your unique needs are. I'll give you a couple of examples. I work with cities, counties, and school districts. And with some of our cities, they have board members that are paid. They're paid very little throughout the year, like $5,000 a year, or volunteer firefighters that are paid. They're paid a W-2, but it is like $5,000 a year is what they get for their service. Those individuals are required to be included in the PFML calculation, and they would be eligible for benefits even though these cities know that these people are never going to take the benefit. They're volunteer firefighters or they're board members. They're not really employees, but they are getting a W-2, so they are included in the calculation. So there are some unique situations for employers. Um, that you're going to want to take a look at. And just to give employers just kind of a basic idea of the frequency and some of the most common leaves that could happen would be on maternity leave, for example. If you have an employee that is expecting and she takes her 12 weeks of medical leave following the delivery of the baby, she would have that 12 weeks of medical leave under this program paid. And then she can take an additional 8 weeks of bonding time because she gets 12 weeks of family leave, but it's a maximum of 20 weeks total in any calendar year. So if she took the 12 weeks of medical leave, then she would only have 8 weeks left of her total of 20 weeks of bonding time if she took that under this program. The dad or dads out there can take 12 weeks of bonding time, and they can stagger those. So it's not, they don't have to take them concurrent. Mom can take the first 12 weeks and then dad of medical leave, then dad could take 12 weeks of bonding time, and then the mom could take her additional 8 weeks of bonding time because they're two separate buckets. She doesn't have to take them concurrent. 8 weeks of bonding time after that the father takes his 12 weeks. So this is potentially, and I have employer groups that have husbands and wives working for the same organization. So understanding that potentially up to 20% of your workforce could be out at any given time, and we've seen that depending upon the industry and certain industries across the United States and the other states that have a program like this, it can be rather scary and complex for an employer.
Thank you. Another question in the chat is if we choose the private option, are future rates based on a large pool similar to the state option?
So the private carrier is going to base the rate on your demographic and your claims, along with they also weight the pool of their claims within the carrier. So there are multiple weights to it, but if that's what I was saying, if if you have a favorable group, these carriers are really good at underwriting. They know what they've seen in other markets. Their estimates are pretty darn good when they come out with the rate that they're going to offer a group based upon their demographics and the wages. And they're pretty close to that, but it ultimately the rate annually would be based upon the group's experience and the pooled experience within that carrier.
Great. Thank you, Jen. I have no other questions in the chat. If there are no other questions, if no one wants to unmute and ask a question, what we were going to do going forward is the Chamber of Commerce, in partnership with Flagship Insurance, is building out a paid family medical leave kind of information page that'll include information, including the other webinar series, this one, and then we do have a question jump in there, so we'll go back to that. Um, can we mandate employees to utilize PTO and vacation first, reducing the need for the plan to kick in?
No. You can, because on the PFML benefit, there is a 7 day waiting period where you can require that they use their PTO. But no, you can't require them to not get benefits through this program by using their PTO.
Perfect. Thank you. So, we have another one. Um, do we have to sign the agent of record to start getting private quotes versus the state plan?
No. No, we're here to help employers figure it out. I mean, ultimately, our goal would be to say, it would be just like any benefit package. It's easier for one agency to implement all of your programs so that they are seamless and integrated. Plus, you get other things along with other benefits. But if you just want to test the market and see where things are at, we're happy to provide quotes for you.
Perfect. Thank you, Jen. If no other questions, I'm still monitoring the chat while I speak. What we're going to do is, again, the Chamber, in partnership with Flagship Insurance, has been working on getting information out to the membership and to the community on uh, the options that you have. We highly recommend that you contact Jen or Nick or fill out the Jot form to get more information on the private options that are available for you, and whether that's better or the state option. And we got another question.
Yeah.
So, would employees under a current CBA, so union employees, be included on this?
Okay. Yeah. If they're paid a W-2, yes.
Yep, it's almost all employees at LW2. So,
Yes. But I have union groups, and it depends on how your union is structured. So one of my groups, they are going with the private option because they got a better rate, and they're holding currently they pay 100% of the short-term disability policy, for example. But they're not going to pay 100% of this program. So they had to negotiate on the side, even though they're not within their negotiation period, just because this is a new requirement and their contract allowed for them to come back to the table to negotiate on what this looks like. So it kind of depends on some of those factors too.
great. Thank you. Um, If there are no other questions, I think I've kind of laid out what we're planning on doing, and we're building out that information. But always, I threw in the chat, the emails for Jen and Nick Kuchenbecker. Great resources. Otherwise, the Jot form we'll get that out also. And yeah, with the program coming up on January 1st, 2026, I highly recommend that you look at all of your options as a business. Jen, thank you so much for taking the time today to present. And
You're welcome.
yeah, thank you. Thank you, everyone. Have a great day.
Thank you.